Well, the SGX Nifty is indicating a big start to kickstart trade, so we'll be starting closer towards that 9,700 odd mark, factoring in closer around 120, 130 point gain, because you're comparing the SGX Nifty rate with the Nifty futures. That means that, in fact, we're bracing ourselves for a gain of around 140 to around 150 points odd. Let's see whether or not that happened. But remember, the last few trading sessions, the Nifty has been on a winning streak. The Nifty, in fact, is up close to around 6% odd. May belong to the bears. At the start of last week, we would have been saying, hey, the Nifty is going to be down nearly around 800 points for the week. But in the last three trading sessions, the Nifty gained close to around 6%. So for the month of May, in fact, ended with a cut of only around 300 points or thereabouts. What's encouraging is Friday's trade. Take a look at the intraday chart. The dip was there and the dip got bought into, which is very positive from a bull's point of view. And if you're looking at the flows, well, they've been fairly positive. Though in Friday's trading session, the flows were skewed for the FIs because of the MSCI rebalancing. That's where the gross buy numbers and gross sell numbers were very, very large. So that's something that you should keep an eye out on. But otherwise, the flows are more or less positive, which is good news from a bull's point of view. What do the FIs do in the F&O market, though? They unwound longs. So close to around 11,000 contracts is what they unwound on index futures. Remember, they were net long on the index and they're still net long on the index. They bought calls and puts, but the positive is they're writing puts, and they wrote more than 20,000 put contracts, which is a positive, and the positioning on the index is nearly around 60% on the long side, with 40% on the short side. So even after unwinding more than 10,000 contracts, they're still net long on the index. And the biggest positive is the put writing. That's telling you the bulls want to defend the lower levels. Today, the markets will be reacting to two data points coming in. One will be the GDP number. For quarter four, it looked a little bit better than what we were working with, though the first three quarters, the number has been revised low. So that's one data point. The second factor is, and Nomura in their note, they say that quarter one GDP number could be the last year for 2020 because they're expecting a decline from year on. In terms of the fiscal deficit number as well, that was higher than what was budgeted. Obviously, that's mathematics playing out because the base has been reduced. That's the GDP number didn't grow as much as earlier anticipated. But restarting the economy, that's something that the stock market will focus on today, and that's going to be of prime importance. How does things function from here? In terms of technical levels, well, you're looking at the levels, they should come up for you on the screen. The nearest possible level will be the 20 DMA. Now, that's at around 9,225, but that's a distance away from where the Nifty is trading at. We ended at around 9,580 odd, and the SGX Nifty is indicating a start closer towards 9,700. Short point, recent high of around 9,889. That's the high we hit on April 30th. So that will be a bit of a target for the bulls. On the downside, Friday's low, 9,377. That'll be an important level on the downside. For starters, we're going to start off in the green, makes the second half of trade extremely crucial. But let's get straight to the big macro cue then. The Indian economy grew at its slowest pace in over 10 years for the last fiscal, at around 4.2%. The growth rate was the lowest since 2008 financial crisis. This data captures only the last few days of March when the economy was under lockdown due to the coronavirus. Lata joins us this morning to break up those numbers and make sense of that. Morning, Lata.
Good morning. Well, it's over 48 hours old, so well digested. The GDP numbers. For the record, the 3% or 3.1% fourth quarter is better than our poll. We were expecting only 2.2, but all that happiness got washed away from the fact that Q1, Q2, Q3 were revised much lower, between 40 and 70 basis points. So if you took 9 months, it was lower by half a percentage point compared to what we were working with the previous numbers. There is also a doubt about credibility. I mean, they revised the numbers in February 28. Again on May 31st, it also makes the numbers less believable. There is also a strong fear that since the first three quarters were reversed lower, and the government admits, the CSO admits, that they didn't have data because a lot of GST, a lot of payments, the deadlines were pushed because of the lockdown. Therefore, they did have a data problem, and therefore the strong fear is this 3.1 won't hold, and therefore the 4.2 GDP could also become 4.1 or 4%. The other point to note is where the growth came from at all for that 3.1 or for the full year 4.2, largely from agriculture, which grew at 5.9 in the fourth quarter, and government services. You know, when you have agri, mining, industry, construction, finance, etc., the last line is public administration, and that contributed 10.1%, which means government spent big. Without that, taking away agriculture and taking away public administration, the GDP growth was only 1.1%. That's core GDP for you. Within that, if you looked at it from the expenditure side, the bad news was in private consumption. Private consumption has been the engine. As you know well, there's been no capex. So private consumption has fallen to 2.7. I mean, hitherto, we could maintain the 7% growth only because private consumption was growing at 7 to 10%. So if that comes down to 2.7, there is really no prop, and capex, for what it is worth, was minus 6.5. It is the third consecutive quarter of minus in capex, which means we are eating out because of depreciation and not putting in fresh capex. Okay, FY20 GDP, a few quick points. Growth has been falling for 4 continuous years. You know, we were 8% 4 years ago, then we came to 7% plus. Last year, FY19 was 6%, and this year we are at 4.2. So this is a slowdown that has been in the making for some time. If you looked at it quarter-wise, then this is the 12th quarter in a row that we are ticking lower. Real GDP is the lowest in 11 years. We know that. The previous below 4% was the Lehman year. The nominal GDP, and that's important, which is real GDP plus inflation, is the lowest since 1972. Now, that is very important, because ultimately you and I only look at nominal GDP, EPS numbers. EPS is a nominal GDP number. If that falls so much, then growth becomes a problem. Taxes are based on nominal GDP. Earnings are based on nominal GDP. Consumption for the full year was 5.3%. And there are chances that this is going to fall in the coming quarters because of job cuts and pay cuts. Capex, again, I told you, for the full year, it is minus 2.8. Now, when capex falls, the potential to grow in future years also falls, because you're putting in less capital, and therefore the slowdown may last longer. Government spending at 10% is good, but that makes the problem of fiscal deficit. For the last 4 years, government spending has been double the rate of GDP growth. And finally, you will reach a level where you can't go on spending because debt to GDP has become too high. Indeed, that is my problem. Public debt to GDP is now at 70%. And with the kind of fiscal deficit we have this year, we will go to 80%. And the global rule is when debt to GDP goes above 80%, yields will rise. You cannot borrow cheap. So that way, the numbers don't look good.
Okay, all right, Lata. Thanks so much for that. Well, let's move on to the other big Q then. Auto sales numbers for the month of May will release later today. The impact of the coronavirus-induced lockdown will be the key factor to watch out for, and as well as management commentary. Sonia joins us to run us through the key expectations. Hey, Sonia. Good morning.
Hi, Nigel. Good morning. Yes, as you rightly pointed out, the impact of the lockdown will definitely hit the auto sales for the month of May. The lockdown, remember, began on the 24th of March, but many of the auto companies shut down their production as well as dealerships on the 21st itself, and that is extended till the end of May. Now, the brokerages are expecting both passenger vehicles as well as two-wheeler industry to decline about 75 to 85% in the month of May. In medium and heavy commercial vehicles, there was almost zero demand. Dispatches were very low. There was no demand for new trucks, and only 30% of the existing truck fleet was plying on the road. So the situation was much worse for the medium and heavy commercial vehicle sector. The only sector that has done well this time around is tractors, because of the good Rabi harvest and a high government procurement of wheat. So tractors is one segment. So you could see stocks like M&M and Escorts outperform today in terms of numbers. Also, as we know, the production ramp up across plants was quite low due to supply chain bottlenecks, labor shortages and COVID cases amongst workers. Now, just to give you some estimates of what the numbers could look like, Nomura expects Maruti sales to fall by 77% in the month of May to come in at 30,600. Ashok Leyland sales could fall by 92%. As I said, things were quite bleak with the commercial vehicle sector. In two-wheelers as well, Hero Motor could see about an 85% drop in sales. Bajaj Auto could see about a 67% drop in sales, because they have a large chunk from the export markets, and exports did reasonably well. TVS Motor as well, 72% drop is what we're expecting in sales. Now for M&M, the tractor sales could fall just by about 15% because, as I said, things are not looking as bad there. But auto sales down about 72%. So pretty much a washout month, but it's something that the street was expecting. Back to you.
Okay, all right, Sonia, thanks so much for that. Well, on that note, we'll slip into a short break. You come back, we'll tell you the cues coming in from the derivatives market.